So I just wanted to talk today about R&D Tax Incentive mainly, and then go into some of the other government grants that are available for companies who are undertaking R&D and commercialisation activities. I guess in the context of where we are in today, the R&D program in Australia is been touted as the flagship program to support innovation, and it's a federal government program. In 2012, there was quite a significant change to the program to really give further support to the SME sector, to be able to give cash refunds of their tax to enable them to reinvest that in further R&D activity. Over the last 5 years, at the margins, there has been some people pushing the boundaries of the R&D scheme, and because of that, it now has a little bit of a taint on it, that there is widespread rorting of the program. And Scott Morrison even said that in his speech at the banking inquiry last year, that he felt that particularly the larger end of town were using R&D tax incentives to lower their corporate tax rates. With that, the government has recently introduced some proposed changes, which I'll talk about, to the tax incentive. And in the background to that, we have a very, very aggressive ATO at the moment, particularly with the small and medium businesses. So if you do have any clients that are claiming R&D, they do need to be careful, particularly if they do get an ATO review, of to how they respond to that and deal with that in the first instance, because we are seeing the ATO bullying clients into paying back money that they shouldn't be in a position to be paying back. I'm more than happy to take questions as I go. It's not a massive audience, so if you've got a question at any time, just put your hand up or shout out, and just keep it more interactive, because I do want to keep you engaged. I know sometimes these sort of sessions, your mind can kind of wander. So yeah, if you find that happening, just ask a question. So what is the R&D tax incentive? So broadly, it's a broad-based entitlement program available to all companies across all industries. And that's one of the key hallmarks of the program. Back before we had R&D tax incentives, most government funding was provided through grant programs. And there was a feeling that the government wasn't very good at picking winners, and that I think Canada was one of the first countries to introduce a tax incentive back in the 80s, and Australia followed that lead because it seemed to be the easiest way to get money into the hands of business, and to not be, I guess, pick and choosing as to who may be best to give that money to. With the changes that I'll talk to shortly, one of the problems that we have with it is that it is no longer going to be industry agnostic. There is a very much bias against manufacturing, agricultural, mining companies, and focus towards the service industries and biotechs. So obviously claimants must be undertaking eligible research and development projects. So I'll talk a little bit about what's eligible research and development. It's an interesting one to deal with, the program, because it's jointly administered. So it's jointly administered between AusIndustry, Department of Industry, and the ATO. So AusIndustry has the running of the administration of the program and responsibility over the eligibility of your R&D activities, whereas you claim your costs through the income tax return, so the ATO gets involved in terms of eligible expenditure. There is quite a bit of crossover, obviously, in those responsibilities. The ATO will argue it needs to understand the activities to determine whether the costs you're claiming have nexus to those activities. So if you want to claim the R&D tax incentive, you need to register your activities with AusIndustry within 10 months of your year end. So it's a retrospective program in that we're looking back at the previous financial year, you look at the activities you did in that year, and you fill out a registration application form and lodge that with AusIndustry within that 10 months of year end. So if a 30 June year end company, they've got till 30 April, 31 December, 31 October, and so on. So nationally, since the introduction of the R&D tax incentive, which came in 2012, as I mentioned, there's been an increase in the number of claimants. So back in 11-12, there was about 11,000. We've now gone up to about 15,400 as of the beginning of this year. Interesting enough, you'll see that R&D expenditure is dropping. And now that's the result of two legislative changes that came in over the last few years. One is that they've capped the amount of R&D expenditure that anyone can claim at $100 million per annum. And you may think, who does 100 million of R&D? Well, CBA does much more than 100 million of R&D. That really affected the big banks, the big mining companies, etc., who all had multiple hundreds of millions of dollar claims. And the other thing is that they did a slight lowering of the benefits that were available in 2016-17 as well. So just on a Queensland basis, interesting enough, Queensland, the amount of R&D expenditure hasn't dropped as significantly, and I would say that is because where you're lodging your application, most of the bigger players are going to be Sydney, Melbourne, Perth.
Can you talk about maximum around the claim? Is there like a rule of thumb minimum?
Yeah, so you have to spend at least 20,000 to claim. To be honest, at 20,000 you needn't bother. It costs you more in compliance than the benefit you get from that. So in terms of the benefits, and I'm talking about the 2017 financial year, the legislation that we've got before Parliament at the moment is supposed to be backdated to 1 July 18. So this is for the 17-18 year. For companies with under 20 million turnover, it was a 43.5% refundable tax offset. If you're over 20 million, it's a 38.5% non-refundable tax offset. So just in terms of, I'm not sure how much tax knowledge people have, but if you think about how your tax works, if you've got assessable income, you take off your deductions, you get taxable income and you pay tax on that taxable income. With the R&D, your R&D becomes non-deductible, but then you get the offset at that. So at the rates there, the 43.5% and the 38.5%. So with the refundable offset, the good thing about that is that if the company is in losses, it can actually cash out those losses. And if they've got sufficient losses, get up to that 43.5% on every dollar they've spent on R&D, they can get that cash back from the ATO. If they're over the 20 million and they're in losses, then the additional amount becomes further losses that they can carry forward and offset against future income. Does that kind of make sense?
Is that really just to give the cash amount back to the smaller companies?
Yeah.
That's
now,
the incentive part of it.
That's right. But the interesting thing is, and this is not well understood, is that the refundable offset, it's a cash flow, it's a timing thing. You get the cash now, but one, you lose the carry forward losses of the 27.5% that you would otherwise be paying as a small business. But also, once you become profitable, you cannot pay out franked dividends until it's clawed back all the refunds that you've previously received. So a lot of people sort of skip that story, and when we explain it to clients, most of them say, I don't care, I just want the cash now. But for ones who are transitioning between becoming profitable, it is an issue for them if they haven't quite realised that that's the case. So just some basic eligibility criteria. So you have to be Australian company or permanent establishment. Makes sense. You need to be lodging a tax return in Australia. Obviously, you need to be carrying out research and development, and it needs to be your research and development. And you need to be conducting eligible R&D activities. And as we mentioned, you need to be incurring at least 20,000 to put in a claim, unless you're just paying what we call a research service provider. Then you can be under 20,000 to claim.
Just a quick question on that. You mentioned that the 20,000 is probably not enough to cover the compliance costs, but what do you think the point would be that it would be worthwhile pursuing?
It depends on the business how complicated their R&D program is, because when you register with Oz Industry, you need to set out to Oz Industry what's the objective of your project, what was the new knowledge that you seek to gain, how did you know that wasn't already available on the market, what were the actual core activities you did in that year, what were the supporting activities. You need to have all the contemporaneous documentation to support that. You need to obviously put your tax schedule together to lodge with the ATO. So the time involved in that process, if you've got all that information readily available and you're a small business and you're desperate for cash, you might, or a one-man operator, you might choose at 20,000 to lodge a claim. But we find less than 100,000, it's marginal as to whether you would.
So some of the grants are more beneficial in that space?
Yeah, that's right, yeah. Sorry, one thing I do want to make sure mention too is you must be a company. So you can't be operating through a trust. So it's only companies that are able to claim.
But I guess
sole trader partnership, it's got to be company.
That must be a PTY Ltd or a public company.
I was just going to say, when he was, fellow over there was saying, is it better to go for grants? The R&D program is an entitlement program, so if you've done the activities and spent the money, then you're entitled to the offset, whereas grants are generally a competitive process, so you're competing against 100 other companies to go for one grant.
And
a bit of a harder process.
Absolutely, and also it's prospective with grant funding, so you can't have already spent, for the majority of grant programs, you can't have already spent the money. So the important thing is to be able to claim, you have to have a core R&D activity. So core R&D activities are described as experimental activities where the outcome couldn't be known in advance based on current information, knowledge or experience. And with that knowledge or experience, we're looking at what we call the competent engineer test. So people with competence in that field believe that it couldn't be known without going through that experimental process. Have to be done in using a systematic progression of work based on principles of established science. And here we're talking about the computer and physical sciences, so we're not talking about humanities, etc. There needs to proceed from hypothesis to experiment, observation, evaluation, lead to logical conclusion, and be conducted for the purpose of generating new knowledge, whether that's in the form of new or improved products, processes, services, materials, devices. Funnily enough, when the tax incentive first came in and this language came into the tax incentive from the old tax concession that we had, Oz Industry were very much of the view, oh, don't worry about the words hypothesis, that sort of thing. We know in business that's not the language that you speak, so that's fine, just have an aim. Now, when we register activities, we have to have a valid hypothesis. And it's quite, a prescribed format that they want to see every experiment written up as part of the application form. So we have moved, I guess, to this much more, what's the right word? It's pedantic, I don't know, environment that, So once you've got a core R&D activity, you're entitled to claim the R&D tax incentive. But obviously, if we narrow the scope of activities too much to just core R&D activities and you're only providing funding for that, your project might not progress because it's not providing enough incentive for you to continue. So the program also supports what we call supporting activities. So those are the activities that are directly related to the carrying on of your core activity. There's a couple of circumstances where you can only claim those directly related activities if they're undertaken for the dominant purpose of supporting the core R&D activities. And that's where you're producing goods or services, or where the activities relate to what we call excluded core activities, which I'll mention in a second. So examples of supporting activities are things like project management, research into existing technologies, fabrication of standard components that you might need to then test in your prototypes, etc. So it's all those things that aren't the experimental activities themselves, but are necessary for you to complete your R&D activity. So there's a number of things, and this is an exhaustive list, there's a number of things that are listed in the legislation as being ineligible to be core R&D activities. They can still be supporting activities provided they meet that dominant purpose test. So they're fairly common sense, I guess, for the main part. I guess the bottom one there, the bottom three there are probably the ones that we come across the most. There's actually a court case that's just, it was an AAT case recently in regard to the statutory compliance where it's come out in favour of Oz Industry, stating that anything to do with statutory compliance and standards, and in this case it was in regard to environmental regulations, should be excluded activity. That one, it's interesting because we did have a case a couple of years ago where the AAT said that it should be read more narrowly than that. So it's interesting at the moment. That case is likely to be appealed, the one that was just handed down the other day. So we expect that might get overturned as well. As I mentioned, we're only looking at physical and computer sciences. So research into social science, arts and humanities is not what we're looking at here.
Just to clarify, that's statutory compliance. So even things, I guess, as an example, software to allow a business to more efficiently manage its statutory compliance obligations would not be.
No, it could be. So this goes into the last one as well, in that developing, modifying or customizing computer software for the dominant purpose of internal business administration is not eligible as a core activity, can be supporting activity. What we're talking about with internal business administration is the functions that any business would have. So things like normally your ERP systems, but your payroll, your inventory management, those types of systems. Anything that's considered customer facing, so anything where a customer is interacting is not considered to be internal business administration. It really depends. I guess with the activities with statutory compliance, the way we've always interpreted that is if you're just doing stuff to meet standards as part of your project, that's not eligible. If you have to undertake R&D activities to be able to meet that standard, then potentially you are in. But this new case is now saying that latter could be excluded as well. So that's sort of overview as to what is eligible R&D. It is quite grey. And this is where I guess we get into debates with Oz Industry quite regularly about our view as to whether it's R&D or their view. Their view is obviously more likely it's not. Oz Industry has changed its role over the years. Its role used to be to support the scheme and bring people into the scheme. It now sees itself as a police of the activities. So moving on to expenditure. So basically you claim your costs associated with your project, and normally that salary and wages is your main cost and or other people costs, so contractors as well. The other direct costs, so travel, consumables, overheads, all those sorts of things can also be included. We can't claim the outright cost of tangible depreciating equipment. You can only claim the depreciation on that whilst it's being used in R&D activities. So it doesn't fund the new equipment just being installed into a business and turnkey operations. It really funds the research into developing that equipment or perhaps integrating that equipment, but not the actual cost of that equipment itself. And importantly, as I said, overheads are a proportion of all your other P&L costs. So traditionally, people have always apportioned their overheads based on salary time. So I work out out of my 100,000 of salaries, 10,000 spent on R&D, therefore I take 10% of my rent, my electricity, everything else. The ATO is now saying that it doesn't like that anymore. It prefers you need to look on an individual line item by line item basis and work out an apportionment methodology that makes sense for that line item. So it might be floor space, it might be head count. You need to look at the particular expense item and work out what the best method is. So obviously with all these things, as I mentioned before, with what Oz Industry is now asking us to do, what the ATO is now asking us to do, those compliance costs are going up and up. And so that benefit in claiming, there needs to be a substantial amount of R&D to make it worthwhile. I probably won't go into this too much. With some of the issues that we're seeing from Oz Industry in terms of the way they want things scoped. It's always a bit of a challenge to work out what is the most cost-effective way to present the activities for a client versus what Oz Industry want in the level of detail. This is what I was mentioning before about the fact that they're questioning where the hypothesis is unclear, etc. Skipping over a bit. Importantly, we have seen instances where companies, particularly startup companies, they try and claim a sweat equity cost that's not an incurred cost for tax purposes. So if you want to claim your own time, there has to be a salary cost that's gone through the P&L of the company. You can't just make up a cost. If costs incurred to associates have to be actually paid, so not just incurred for tax purposes, but they actually have to be paid in that financial year. So this is where a lot of businesses we find running all their R&D through a trust. They've got a company that they owns the IP. That company needs to pay, to be able to claim, that company needs to pay the trust prior to the end of the financial year. Similarly, if you're an owner of a business, you'd be considered to be an associate, therefore you have to pay your costs prior to the end of that financial year to claim it in that year. If it's not paid in that year, you can still claim it, but you can still claim it, but not until it's paid. and you can't take a deduction in the year in the prior year if it's not paid to a latter year. And one of the biggest things we're seeing at the moment is the tax office are very much focused on records and particularly timesheets for people involved in R&D. I've got a case going at the moment where the company, three-man band, has solely doing R&D. They've had success in the past selling products, things to places like people like Sony, etc. They've over the last few years dedicated themselves to this particular technology. They have managed to have 28 patents granted during that period, and the ATO is now arguing that because those people didn't keep timesheets, there is no evidence that they did R&D during that period. So we've given the ATO 15 lever arch files of documents to consider. As I mentioned, it needs to be your R&D. So all the law says is that the R&D is conducted for you and not to a substantial extent to another party. Over the years, the tax office has issued a ruling, and it was actually in the EM to the legislation, the Expenditure memorandum to the legislation, that basically we look at 3 tests, and it's on the balance of those tests. So who has control of the direction of the R&D activity, who bears the financial burden of those activities, and who effectively owns the IP, not necessarily legally. So one of the key things is most people think to claim R&D you have to be the owner of the IP. That's not necessarily the case. So the key thing we always look at there from the financial side is, am I being paid a lump sum to develop something, or am I being paid time and materials? If it's the latter, then I'm probably not at financial risk. So we're always looking at here as to, particularly where you're doing R&D for a client, or that whose R&D actually is it. So some of the things that we come across, and these are actual examples that we haven't given too much detail on to protect the names of our clients, but these are a couple of the ones we've come across recently. So first one there, design, develop and integrate an advanced web and e-commerce platform. So one of the things when you think about manufacturing type clients, you might forget the IT systems. As I said before, where the IT is for that internal business admin, then you can't claim it, but anything that's got that customer facing element could be potentially eligible. Improved processes is always is one that comes up a lot. So again, it's not necessarily new, it can be improvements, provided we meet those other tests that they've got to go through that experimental process, and the outcome couldn't be deduced in advance by a competent professional. So yeah, any time you're looking at efficiency and improving the business, you may have an element of R&D associated with it. One of the things I thought might just be interesting is there's a whole stack of boutique R&D lenders that have cropped up over the last few years, particularly because of this refundable tax offset. They all vary in the way they do this, and I don't know much about finance, so I'm not going to. But they basically they generally they're only looking at the refundable clients. They want to know that they've got sufficient tax losses. They don't want other ATO debts, because ATO obviously takes their money first, and they don't want any security over the assets in the entity. We've had a few clients come to us, and either clients or others come to us and ask for this letter of comfort to give to their lender as to the likelihood of them receiving that refund and all the strength of the claim. So we're obviously more comfortable doing the ones that we actually do the R&D claims for. We had one recently where we just had to say no to, because we weren't comfortable with it at all. But yeah, there are a few of these providers that have popped up from time to time. Macquarie were probably the first ones to get into it. Incredibly expensive.
Can I claim the interest as R&D costs?
No. No, so actually there's only 4 things that are explicitly in the law excluded from R&D, being eligible R&D cost. Building expenditure, plant and equipment, the outright cost of plant and equipment, what we call core technology, so that's when you're purchasing somebody else's R&D, and interest. So, budget reform changes. So for the under 20 millions, it's not that significant. I might have been in the paper today saying it was, but it's actually not. So what they're saying with the what's happened with the refundable offset? So when the refundable offset came in 2012 in its current format, one of the I guess points they wanted to raise is over the years. Go back a step. Back when they first introduced R&D in 1986, the corporate tax rate was 48%, and it was a 150% deduction. So basically, your benefit was 24%. Over the years, the corporate tax rates dropped and the R&D rate dropped. So it came down to a standard rate for most companies of 7.5%. So in 2012, when they did this reform of the what was then the tax concession to the new R&D tax incentive, they said we want to turn it into a tax offset, not a tax deduction, because we want to decouple the R&D rate from the corporate tax rate. So if there's changes in the corporate tax rate, the R&D rate stays the same. So originally it was a 15% refundable rate and a 10% non-refundable rate. Then, as the corporate tax rates were reduced to 28.5%, they introduced legislation to reduce the R&D rates by 1.5% to coincide with that. And then, since then, the corporate tax rate for companies under 25 million has dropped to 27.5%, and the R&D rate is now at the 43.5%. So it's basically a 16% benefit. So they don't like this. So now, with the proposed changes, they're introducing that the R&D rate will be 13.5% above the corporate tax rate, whatever that way may be. So with the current proposals to reduce the corporate tax rate for companies under 50 million to 25%, that will effectively reduce their offset rate to 38.5% from the 45% it was when the scheme was first introduced. The other thing they're doing, and this is where I was going back to the fact that the program is supposed to be industry agnostic, is that they're introducing a cap on the amount of refunds that companies can get, and that cap's going to be $4 million, except if it relates to clinical trials. And this was something that Oz Biotech pushed very hard for, and they managed to get into the draft legislation, into the bill. In the background, we've had the AMEC, which supports the small medium mining companies, trying to push forward for a exclusion from the cap for projects that already have investment on the basis of the R&D refunds, so particularly around the lithium ion type projects that they've got over in WA, and the government said no. So they're allowing the clinical trials but not these other projects. That's the changes for the refundable offset. One of the interesting things with this, the changes that have all been announced, is that they were announced in a bill entitled Making Multinationals Pay Their Fair Share of Australian Tax. There is some proposals in that bill around thin capitalisation and transfer pricing, but the vast majority of it relates to the R&D tax incentive, and how that is making multinationals pay their fair share of tax, I'm not quite sure. The other thing that they said is that the purpose of introducing these new measures is to stop companies claiming business as usual expenses and to improve the integrity of the program. But all the measures do is reduce the rates available to companies. So it's pretty obvious, just a cost-saving measure. Back when we had the 2016, there was a thing called the Triple F Review, which was Bill Ferris, Michael Fraser and Finkel. They did a review of the tax incentive and came up with 6 recommendations. And then the government sat on that proposal for quite a long time, and then has introduced only the recommendations that relate to reducing the amount of money they're going to spend, and they've actually twisted them slightly. So with the non-refundable, this is where it gets a bit messy. So the proposal for the companies with over 20 million turnover, and a company over 20 million is not a large business necessarily. What they're introducing there is the R&D rate available will be based on the company's R&D intensity. And that intensity is worked out by taking what would be their R&D expenditure worked out under the tax provisions at the end of the year, and taking that over their accounting expenditure worked out under accounting standards. They've now softened that slightly to say we recognise that not everyone gets audited, so therefore as long as it's general accounting principles. So what they're proposing is that if you have 0 to 2% R&D intensity, you get a 4% rate. The next 3% you get at 6.5%, the next 5% at 9%, and over 10% at 12.5%. And those rates work like your marginal tax rates. It's not I spend over 10%, therefore I'm entitled to 12.5%. So we've got a large technology client that currently spends about 20% of income on R&D activity. Anyone who's spending over $20 million, to have that higher intensity is quite rare. Their effective rate is going to go from the current 8.5% to 9.3%. So these rates aren't nearly as generous as they look. You have to be spending over 13.25% of your total expenses on our R&D activity to be better off under these proposed changes than previously. So very few businesses will be better off. Majority of companies in the manufacturing, agricultural space, mining space are going to be in that first bracket at 4%. And globally, there's been a lot of studies done on this, and 4% is not enough to incentivise. 4% is also not enough to outweigh the costs of compliance. So majority of those companies will drop out of the program, we expect, completely. Companies, interesting enough at the moment is that a lot of our software development clients are over that percentage, but in addition, they really like the fact they get the immediate, they claim their software development as R&D, they get the immediate deduction. Otherwise, for tax purposes, it would be over 2.5 years. So they will keep claiming regardless of whether they're in that bracket or not. But a lot of the manufacturing, etc., standard, normal industry type clients are likely to drop out of the program. A couple of other measures. So at the moment, that $100 million cap is going to be increased to $150 million. So the proposal is that this is going to encourage large companies to undertake additional higher intensity R&D. We don't think that's going to achieve that at all. The changes are supposed to take place from 1 July 2018. They've just been introduced into the House on Monday or Tuesday, and are likely to go to Senate committee. And so it could be quite a while before we get these changes. So we don't know, basically, whether they're going to come through in their current form or not. And obviously, companies that are already making decisions as to what benefit they're going to get, they don't know that at this stage. When they introduced the tax incentive in 2012, it took about 2.5 years for them to get round to that. So that was originally proposed in 2008 and came through in 2012. So whether we get this next year or not, we're a bit unclear. The thing that we do know is that Scott Morrison is very much for these proposed changes. Labor are sort of on the fence. They haven't made up their minds if they're going to support it or not yet. So that was the R&D tax incentive. Do I have any other questions on that? Yeah.
My question. Say the customer is not very sophisticated and has been expensing out a little R&D software to provide the service for the last 3 years. Can they still make avail of this offset at some stage, or if it's too old, it doesn't?
No, so you claim retrospectively, but you've only got 10 months after your year end to register those activities. So they could go back, if they want to go back to 2017-18, they've got time to do that. They wouldn't be able to go back to prior to that. So any activity that happened in that year, they could still claim. If you can prove exceptional circumstances, then you can ask for permission to go back further, but they're trying to stamp that out. Yeah. One of the things that I didn't have in those slides, just for interest, is the R&D activity has to happen in Australia unless you get what we call an approved overseas finding. So you can go to Oz Industry and say, I need to undertake this activity overseas, and if you get approval for that, then you can claim overseas costs. That happens. What we need to show there is that, I guess there's 3 things we need to show. One is that there's a scientific link between what's happening overseas and what's happening in Australia. And what we look at there is you couldn't complete the activities you're doing in Australia without the assistance of that overseas. We need to show that you couldn't do that activity in Australia due to facilities, expertise, whatever the case may be. And we need to show that the actual and reasonably anticipated costs of the project, more is going to happen in Australia over the life of the project than overseas. If that all gets approved, then you can claim that overseas costs. What's interesting is going back to what I mentioned before about that exemption for clinical trials, is the main people who have got what we call these overseas findings are clinical, because of clinical trials that are happening overseas for Australian-based biotechs. And the exemption on the 4 million cap doesn't make a lot of sense to me because we're now incentivising activity that's happening overseas and not in Australia. So that's just one of the concerns we have about the proposed changes as well. I should just also mention that most countries have an R&D tax incentive of some description. And there are instances where you are able to, we've got a company in Australia that has an overseas finding and it is also undertaking activity in the US. We're managing to be able to claim that activity, both the Australian R&D tax incentive, the US federal tax incentive and the relevant state tax incentive that they have there at the same expenditure. Just wanted to touch briefly on the early stage investor program. This is not something that I particularly get involved in, but you may have heard of it. This may be of more interest to you personally. This came in July 2016, basically to try and encourage people to invest in early stage startups. So where you're a sophisticated investor, you can get a 20% non-refundable tax offset to offset the cost of your investment. So the maximum you can claim is $200,000. So at a 20%, the maximum you're putting into a potential entity is $1 million. If you're not considered to be a sophisticated investor, then the maximum you can put in is $50,000. So the early stage investment company has to satisfy some criteria. So that I guess there's two kind of baskets it can fall in. The first is that it has expenditure of less than $1 million in the prior year. It's been incorporated in the last 3 income years, less than $200,000 assessable income, and it's not listed on the stock exchange.
Is there a restriction on industries?
No, but they have to, you have to also show that that the company is focused on developing, commercialising. There's kind of a criteria to work out whether your company is considered one of these or not. It's a self-assessment basis, but you can go for an ATO ruling as to whether that company satisfies the definition. Have you done any of those, Dylan, or no?
I've looked at you, but it's quite
Specific.
requirements.
Yeah. And you can't take more than 30% equity in that business. So I just briefly wanted to touch on that one. Another one a lot of companies get involved in is a thing called accelerating commercialisation. So this is part of what the federal government puts under a program called Entrepreneurs Infrastructure Program. There's 3 limbs to that program, but this is the one that most people are interested in. So this provides match funding up to $1 million, so $2 million project, to basically look at a new innovative product, process, service, whatever the case may be. It is quite difficult to get. One of the difficulties with it is that you need to show that you can share your fund of the project, but you also need to show that you couldn't fund the rest of it, and that you've exhausted other opportunities. So you've approached the bank, you've approached the VC market, you've got evidence that you've done all of that and no one's going to give you the money. And this is always the thing that I kind of scratch my head at. If nobody else thinks it's a good investment, I don't know why the taxpayer should be funding it.
So you actually have to show that you've expended that money, not just, if you did something that required $2 million and you go, I've got $1 million, that's not good enough. You have to have spent your
No, you don't have to have spent yours. You've got to show that you're, yeah.
It's a bit of a narrow window.
The only good thing about this program is that the Oz Industry have what they call commercialisation advisors. So they're contracted to Oz Industry to provide advice around the Entrepreneurs Infrastructure Program, but in particular with this program. So they will guide you through applying for it. They won't let you, or they'll discourage you from putting in an expression of interest and going for a full application unless they think you're likely to succeed. This program's open continuously. It's got a panel that meets about every 3 to 4 months to assess applications and provide funding. Because of that process where the companies are guided through eligibility or not, about 60% of those that put in full applications do get funding. So if your commercialisation advisor is encouraging you to do this, then you probably should, because you're probably going to get the money. Again, we see quite a few of these in the biotech space. They really like something that's quite innovative to Australia. This is probably one Dylan knows more about, the Advanced Manufacturing Early Stage Research Fund. These guys have got money. So this comes under the Advanced Manufacturing Growth Centre. They've been approaching us saying they've got money to give away and not enough people are approaching them. The good thing about this one as well is they actually basically write your grant application for you. So again, a little bit like your commercialisation advisor, they'll come in and talk you through whether you're likely to get some funding. But unlike Commercialisation Australia, where you've got to then go away, write up a whole application, have all your revenue models, etc., they do it all for you. So if you've got any clients that might fit into this criteria, it's worth, we've got the contact details of the guys, and they're definitely after, particularly anything in the defence industry, they've been saying that they want to look at. So
Excellent said that one. The assessment criteria is not based on turnover on that one, it's based on the number of employees.
Yep.
So whilst we mention SME, 200 employees can be, or less, can be a very big business.
Yep. So that's quite standard. The 200 employees, this is a federal program, but the 200 employees is what the state government seems to be using as its criteria for the small, medium businesses. And we're finding the state is even a little bit flexible on that if they find something that they want to fund. I was told I wasn't allowed any memes in these presentations, but I thought it was a bit boring otherwise. So this was a bit of a tease to the guys in my team that do the export market grants. So export market grants, like the R&D, they're an entitlement program. So it's not competitive merit based. If you've spent money on eligible promotional activity, then you're entitled to get up to 50% reimbursement. To be able to apply, you need to have spent a minimum of $15,000. Austrade take a $5,000 admin fee, they call it, and then you can get up to 50% of what's remaining back from the government. Regardless of what year end you have, the program opens 1 July and closes 30 November, although there are extensions to 28 February if needed. It really funds. It doesn't fund salary and wages except for where you've got somebody overseas on a long-term basis. So if you've got go and put somebody in Singapore on a greater than 12-month contract, then you can claim up to 200,000 of their costs and get up to that 100,000 back. It covers the costs of marketing visits. So if you're a principal in the business and you wanting to go and try and set up a new export market, then to a different country, then it covers the cost of your airfares and a daily allowance of $350. It doesn't cover your salary or wage costs. It covers marketing consultants, so that's a third party, a little bit like your overseas reps, but more they can be local or overseas to look at marketing expenses for you. Things like advertising on Facebook, those sorts of things, to the extent that it's got international international flavour, you can claim those costs. Patents, trademarks, registered designs, all those things, to the extent, again, that they're international, you can claim up to $50,000 per annum. Bringing customers to Australia, free samples up to $15,000 per annum. Unlike R&D, you don't have to describe in detail what you're doing, you only just fill out some schedules of what you've actually spent. They do audit every first year applicant and then every so often after that. The program has been a little bit oversubscribed. Unlike R&D, it's got a set pool of set pool of funding given to it every year. And there's been more and more applicants, and they've been claiming more and more expenditure. So last year, where we say it's up to 50%, it really depends on how much money everyone's asking for and how many applicants. So last year what they did is they paid out the first 40,000 that people were entitled to, and then the balance of that was paid out at 29 cents in the dollar. Whereas the year before it had been about 63 cents in the dollar. So it dropped quite dramatically last year. As I said, it's a good one in that it's entitlement, so the schedules aren't that hard to fill out. So if you've got any companies that are exporting, it's worth them getting this money. You do have to be less than 50 million turnover, but that's 50 million per entity. So if you've got a group, then that's they don't aggregate the revenues of different companies in a group. Made in Queensland, this is one state development program. Unfortunately, this one's currently closed, but they're currently assessing round 2. This one was really around funding significant improvement to the business, whether that's capital improvement or systems improvement. So with this, sorry, I just noticed here that they've got the round 1 criteria there. They changed the criteria for round 2 from round 1. But basically, you put in an expression of interest of what equipment you wanted to purchase. So this does cover capital equipment, and then they're assessing those at the moment, and they're looking at value for money. So you needed to provide at least 3 different quotes of different equipment. A lot of the businesses we spoke to, they found that quite difficult because they know exactly what equipment they want. They know the supplier that they've dealt with. All their other equipment is from a particular supplier. Why are they going to go and get 3 quotes? But that's government process. Yeah, you have to have less than 200 full-time equivalent employees. Then there's the likelihood is they'll get 50% of the project costs. So last year, the government put some money into this program. They ran it slightly differently, as I said here. You had to get a benchmarking report benchmarking report done. So you put your details online. The government paid for a consultant to come out and do a benchmarking study of your business. They wrote a report and recommended some projects that you should apply for. What happened with that is that about 400 companies went through that benchmarking process, and very few went on and actually put an application in for funding. So they had $20 million to give away, and they gave away $9 million. They've now put an extra $40 million into the program, so they've now got $51 million. And there's some rumours around saying that round 2 is going to be the end of that program, and they're going to give out all of that money. And we've got one client that was a bit haphazard in its application. They went in at about 2 minutes to 5 on the deadline with some errors in it. But State Development have been coming back asking more and more questions. They had representatives go out there last week. The company now has about 300 employees, and we're pretty sure they're going to get the money because the government wants to give away this money.
So 3 different quotes?
This was, yes, for Made in Queensland, was it 3 quotes?
Yeah, I had at least 3 quotes. Yeah.
So were there any additional incentives for equipment manufactured in Queensland or Australia as opposed to...
No, they're more focused on what's state of the art globally.
Okay.
So that's their. It's really about upskilling and advanced manufacturing. So they want on a global basis what is the most advanced equipment. The other problem with this program is that applications opened expression of interest earlier this year. Full applications. People were invited to put a full application in beginning of August. Had to have the full application in by the end of August. They're providing. Supposedly going to give funding outcomes sometime towards the end of this year, beginning of next year, and then you have to have completed your project in 12 months. But a lot of this equipment that we're looking at, it takes 18 months lead time to order. So it's going to be interesting to see how it all pans out.
I'll just make a quick point on that. I had a client apply for this grant, and we were asked to supply a letter to support. So interestingly enough, in the grant application, while they ask for a financier and an alternate shareholder to say that they support the additional 50%, it's actually involved that the financier can't take a charge over the equipment at all. So you just have to tread carefully with any support of that because, yeah, we can't register and charge over the equipment.
Yeah, we had a couple of instances of
Yeah,
that,
we had
didn't
to
they?
go back and amend the letter to take security over other assets of the business
Correct.
and not the asset
Yeah,
that's
yeah.
being the subject of the grant. Yeah,
Because they've got to be pretty strong.
Yep.
correct. Yeah.
There's a whole stack of programs, I guess, under what we call Advanced Queensland. So Advanced Queensland was started up by the Labor government originally with $350 million allocated to it to give away, and that's now gone up to over $500 million. And it's really around the small and medium enterprises. There's a few different programs in it, and probably the most popular is a thing called Ignite Ideas. It's really aimed at that small medium, the very small micro businesses who have got an idea that they've taken to minimal viable product stage, so that it's not just an idea as such. They need to have got to the point where they're ready to start marketing or field testing of that product. It's been highly competitive. So I think in the first round there were about 500 applications, of which about 35 got grant funding. The last round, which was round 4, they had about 75 get about the same number of applicants, but about 75 got funding. It provides match or funding up to $100,000. It really depends on how many employees you've got. So 1 to 5 employees, you don't actually have to provide any match funding. Above that, it goes up to 40% of funding. And then Tier 2 is match funding up to $250,000, and it's match funding 50%. It's interesting with this one. Yeah, again, you have to have less than 200 full-time equivalent employees. They were talking to Advanced Queensland. They're quite lenient on that. So if you're a large business and had a separate company that only had less than 200, they might consider, and does something slightly different to the rest of the business, they might consider that to be still qualify. Again, it's competitive merit based, as I mentioned. One of the interesting things, it's received a little bit of flack over some of the ideas that have been funded. The one that came up and was even talked about in Parliament a few weeks ago was a weight loss app for pets. But it was developed out of Cairns, and one of the key focuses of the last round of this program was that it was for to really support regional Queensland. So that wasn't in the previous rounds. So one of the things we do find with these grants is they're not necessarily consistent. So they have merit criteria depending on who's assessing that and depending on what the flavour is for that particular grant. Interesting, back with the Made in Queensland, that program was originally, how are we going for time? That program was specifically developed for a client that used to be a client of ours, which had been a long-term, well-known Queensland brand business that was struggling. So this program was put together for them. They applied and they didn't get grant funding. So that can happen because the people who are developing these programs aren't necessarily the ones assessing the criteria. So that was pretty much all I was going to cover. There are, as I said, a lot of programs under Advanced Queensland. So we have things like the Business Development Fund, where that's an investor wants to put money into your business. They approach and pitch to the state government. The state government will then match that funding and take equity in that business as well. And then that private investor can buy the government share out over time. So there's a few different programs like that available.
Is this something that you'd take your customers through when they're looking at their CapEx programs or their growth programs, that you've taken through the various grants that are available and incentives? Do you do that?
I'd like to say we were that proactive. We're probably a little bit more reactive.
No.
Dylan probably does more of that because he does more of the strategic.
Strategy of the client, and we're looking at their 2 or 3 year strategy, and we know what CapEx. Then the second question I'm saying is, you want to come in there, Nikki, because there's usually R&D or a grant that they can look at. Yep.
The one of the things that people struggle with is the grants are coming up all over the place at different times, different states, different agencies, and just keeping up to date with what is available and being in the right position to apply for those grants at the right time. We have noticed over the last couple of years a lot more people asking about grants than we've ever had before, and all sizes of business. You know, we had, one of our clients is over 300 million turnover, start asking us about grant funding for a project they've already completed.
Well, that's the problem is if you're not planning ahead, then you need the money now, but you can't start the project till you've got the grant funding. That could take months.
Yep.
So if you're thinking ahead, then you've got a better chance of lining up your ducks.
Yep. Cool. That was all I was going to cover. So.
With the offset, you mentioned that the expenditure has to be Australian. A lot of the software companies need to code, if you're doing a software for R&D, you need to code it overseas a lot of the time, so they claim that. And the second question, instead of this one with the grants, can they apply for more than one grant at a time if they qualify for one?
Yep. So in your first question, as I mentioned, to be able to claim that, if the actual activity is happening overseas, they can only claim that if they've got pre-approval from Oz Industry. So we've got a couple in the software space where we've been able to argue that they haven't been able to get, yes, there are people in Australia that have those coding skills, but they can't get them in the numbers that they need, in the time frame they need, and therefore they have to go to Southeast Asia or wherever the case may be. It's not just for cost. We've got to show it's not just for cost reasons to be able to get that approved. Yeah, but one of the issues we struggle with is how far do we need to go? So if I subcontract my coding to a company in Australia and they subcontract it to somebody in India, do I have to trace that all the way through? The ATO is a bit silent on that. So I guess it's making sure we ask the questions, but they want to see the activity happening in Australia. Your second question, you can apply for as many grants, or generally. Some of the grant programs will say that you can only apply one company, one project, but there's no reason you can't be getting, we've had a company that got Commercialisation Australia, Accelerating Commercialisation as it's now called, Ignite, it co-funded its Ignite Ideas funding, so you can get, as long as they're like one state, one's federal, they'll normally let you double dip like that. So there's no restriction on applying for different grants. Our clients that love grants will go for everything they can. So there's also ones I didn't mention actually. One of the ones popular at the moment is just the waste management ones that have just come up from state development as well. So if you've got any clients in the waste management industry, there's some quite good grants available there as well.